in listen-only mode.
Hey, good afternoon, everybody. Thanks for joining us today. Today at FOMC decision day, so they're going to decide on the rates. It looks like they're going to raise the rates quarter point, but it depends on their language going forward on what they say for other rate hikes. Now, President Trump's not going to be happy that they raise rates, but I think the market's reacting pretty good today. We actually went up. Was down initially on my futures plays. I was traded on Q today and then pushed up and I got a nice play. Me and Rob were analyzing and it actually worked really good to play. And there was the other uncertainty about the partial government shutdown for Friday. That was the deadline. It would kick in Saturday for I think it was the quarter of the government was shut down. But it looks like they're putting a new thing in place. We posted in the chat before, and it looks like they might not have the shutdown now if this gets passed. So that's the other thing that was adding uncertainty. So I think maybe that's why we were pushing higher. Some of this stuff might be not as bad for the week. And if we get some clarity with the Fed today, FOMC, then it could get us off these lows that we've been drifting down October, November, December here. Okay, so no ramp up into the end of the year so far, but maybe passing these two things, and then there's not a lot of news going into the holidays. That might help us. So I'll let Rob go through the charts. We're seeing a lot of things similar today when we were analyzing it. So he'll go through some of the stuff that we had seen on the charts and some of the levels that he's looking at. So good luck. Go ahead, Rob.
All right, thank you, Frank. Good afternoon, everyone. Welcome to another one of our Wednesday webinars. As you know, my name is Stock Darts, and the person you just heard was Stock Guy 22, Frank. Here is some extra information. If you want to follow us, you can follow us on Twitter at Stock Darts or at Stock Guy 22. You can find us on YouTube under the same names, and you can also find me on patreon.com/StockDarts. And soon, hopefully at the start of next year, we'll find Frank and myself again at StockGuy22.com once we're able to launch that site. It's been highly anticipated re-release of the name, and it should be coming pretty soon. So, for those of you that are here, like Frank said, today's an FOMC day, so anything we talk about right now from here to 2 o'clock might be completely invalidated by the time the FOMC statement comes out. I don't really anticipate that happening, but that is always one of the dangers of the FOMC Wednesdays, is you never know what's going to happen once we get the news coming out of FOMC. As you guys know, I am a pretty strong technical analyst that believes that most of what we see on the chart is attributed mostly to selling and buying and selling pressure, supply and demand. And I think a lot of times the news doesn't really affect it, but sometimes the news does affect where we're going temporarily. And I think FOMC on certain occasions is one of those news events that we should watch because it has the ability to impact the markets over the course of sometimes days to even a week or two. So that's something to keep in mind. Now, again, I think more than anything, because, again, I believe strongly in technical analysis, I think a lot of times that if you're in a very strong market, it will shrug off the bad news. And if you're in a weak market, it will react very poorly to bad news. And it will a lot of times ignore the good news. But in general, when you see something like an FOMC day, it's one of those days where you want to be a little bit more careful and you want to wait to see what the reaction is. Because once you see that reaction, it becomes a much easier trade. And I think that's kind of the key. A lot of times when we go over charts on these webinars, we're trying to predict what the market's doing. But I want to make sure that you guys understand there's a critical difference here between trying to predict what the market's doing from a theoretical perspective and trying to predict what the market's doing as a trader. I think as a trader, you're much better off reacting to what the market does. That doesn't mean that you need to chase the price action. And it doesn't mean that you shouldn't try to predict price action, but what you should do is you should try to figure out different scenarios. And then when that scenario plays out, that's when you go ahead and take the play, right? So you don't tell yourself, like right now, we'll talk about FOMC and I'll say, Frank and I were having the discussion earlier how there's a chance that they raise rates today, but there's also a chance that they go ahead and say that they're going to slow down on raising rates as they've hinted over the last couple of weeks. Because they're worried maybe that the market's starting to, or more importantly, the economy's starting to get a little bit slower. And so you sit there and you imagine a scenario. Well, maybe this is bullish if they decide they're going to slow down rates, because that's one of the things that's really been scaring investors. And so that might be bullish, right? But that doesn't mean that I'm going to go ahead and try to go long now, waiting to see it because I anticipate that this might be a bullish day, right? No, I'm still going to wait to see what happens. And then once I see the reaction and I understand where the price action is going, then I can decide whether that idea was right or wrong and whether I should go ahead and try to trade that, right? So that's really critical. And of course, that's not just applied to FOMC. That's applied to any stock that you trade, right? If you think that Amazon's going to do good over the next 2 weeks because you like where it's at on the chart, that doesn't mean that you should just go ahead and guess and play it and then hope that your prediction's right. You should identify a potential scenario where once that scenario plays out, then that proves to you that your thesis is working, and that's when you would go ahead and get long. And that's why a lot of times I'll draw a trend line on a chart and say, well, I'll enter this trade if it breaks this trend line one way or the other, because that's when I know that my thesis is either on trending towards the right play or not. And that's sort of the same thing we need to do on days like today is have an idea of what can happen with FOMC, but then sort of make our way through there based off of what the market does off of that. Now, as usual, we're going to look at the S&P 500, we're going to look at the NASDAQ Composite, we're going to look at the Dow Jones and the Russell 2000. Once we complete those, we're going to look at the US dollar, see how it's behaving, see what it's doing as far as its impact versus gold, silver, and oil, and then we'll move on to the chart requests. Those of you that are in here, we actually have a good number of attendees. If you guys have a stock that you're looking at, or whether you want to enter it, whether maybe you're already in it and you're trying to figure out whether to stop out or whether to take profits, or maybe it's just a chart that you have a question on, a pattern, feel free to put them into the questions tab and just give me a little bit more information as to what you are looking for specifically with that name, and we'll go ahead and review them once we clear out some of the normal stuff that we look at every Wednesday. Other than that, let's go ahead and get started. Let's take a look at the S&P 500 first with the ETF SPY, and you'll see that it has not been a good week so far, right? We opened up down on Monday, down on Tuesday, and on Wednesday we are finally starting to stabilize and put up a bottom. Now, we did have some two nice wicks yesterday and the day before, right? So we did kind of close the day a little bit off of the lows, but overall, this is not really a good look for the markets. Last week we discussed the possibility of further downside, and while it looked like we might stabilize, I did want to point out that we should be more defensive, right? And I think that still applies. If anything, it applies even more importantly now, is regardless of what you think of the market, whether you think it could bounce from here, whether even if it does bounce from here, I think we've reached a critical point in the markets where we need to be extremely defensive with our approach to trading, with our approach to holding trades in our longer term accounts. Right now is the time to play defense. It's not the time to play offense. And that's something I mentioned, or I actually, we discussed it in detail last week, but it's something, again, I want to really stress this week is we are at a pretty critical turning point in the market where things could get a lot uglier than this really fast. And that's something I really want to point out. Even though I think that we maybe bounce today, bounce in the next week. Matter of fact, this could end up being just another retest of strong support that we formed at the start of the year. But I think enough has changed in the market that there's potential for us to crash here, right? And like what I mean by crash is like we can really lose all of 2016's price action pretty quickly. Just take a look and you analyze the weekly chart and you see where the major clumps of price action are, right? And what we have is this year has been basically a nice big rectangle. We've been basically trading the year sideways, which is something that I mentioned at the start of the year. And you'll notice we did that in 2015 through 2016, even the beginning of 2017. And then we had this run up. Now, a lot of times when you're trading a chart, these are vacuums, right? When you have price action just sort of zoom from one level to another, there's not enough price memory here for people to really find a lot of levels of support that they're going to really like. So if you end up losing the space, a lot of times it's a pretty quick move back to the previous space, which is a really long way to go on the S&P 500 now. That doesn't mean, I'm not saying that we get here or that we're going to move from, by the end of the year, we're going to be at 210. That's a very unlikely scenario. But I think that it is a scenario that is in the cards now, whereas earlier in the year, I didn't think that was even in the cards. There was no potential, in my opinion, of any kind of a crash or any kind of real strong market selling correction. And we've seen already a pretty strong correction in the markets. And based off of what I've seen and the way I look at charts and the analysis I've done, there is still potential for a further correction at the very least with the same strength of what we've seen so far. So I don't want to fearmonger or try to scare traders or anything of that nature, but I do want to warn you, something we've discussed, that for the last 3 or 4 years, we've been in a constant state of a bull market that just keeps ramping up, and traders that keep thinking that it's the end. And I kept on saying for the last 2 or 3 years, one of the things I kept harping on is don't worry, keep buying dips. We'll get warning signs when the market's ready to correct. And I think we've seen enough warning signs now where we need to be a little bit more careful. And that's a big change in stance from what I've been in at least for 5 or 6 years now, where I've been almost an unrepentant bull, to the point where a lot of you guys that know me probably don't even know that I would short stocks, right? Because all we've ever discussed is long plays for years. And it's only because of the market that we've been in, and I like to trade based off of a reflection of what the market's doing. And at this point, we're in a very different market than what we've seen for quite a while now. Now, that being said, we are still confirming support at the moment. Now, a lot depends on how we close today and how we close this week. And there's a chance that we do find a bottom here and start making our way back up to try to close the year again at this critical level around 270. I still think that the most likely scenario for us is that we end the year somewhere around this and try to end the year at break even or neutral. But with the breakdown that we had this week, there is also a scenario in play where we can just come up and retest that previous level we just lost. Wow, these ads just continue. And then from there, head right back down, right? So this is a scenario that can happen even if we have a bullish day today, right? Another bullish scenario that we can have is where we just make our way right back up to here. And then from there, maybe even come all the way back to 280 before the end of the year. I think at this point, that's becoming a little bit harder to trust. Not a lot of time left. If you take a look at the calendar, we've got about a week and a half of price action left on 2018. And that seems like too little for us to make it to 280. So I think at this point, 280 is out of the cards as far as what happens this year. And I think the real question is, do we close the year somewhere around 268 to 270 and try to finish? Again, this white box, for those of you that maybe aren't regulars on the Wednesday webinar, is basically the year's opening range, right? You go back to where we opened the year, and this area here is where we opened the year, and has become kind of a turning point a lot of times. Now, you can see price action has gone through it and violated it on several occasions, but it's often been the difference between when the market is healthy and not healthy, whether we've been above or below this critical point. And I think it's a benchmark that will become important as we close out the year is, do we close out the year negative, or do we close out the year with positive price action? So this is a benchmark that I've been watching all year, and I will continue to watch until we close 2018 and see whether it becomes an important area to keep a focus on in the next couple of weeks. And so that's one of the areas I'm watching. I'd love to see us kind of come back up and try to close the year positive and at least say, well, we had a neutral year. We were mostly sideways and building a base. And then maybe it's like 2015 to 2017 where it threatened to break down a couple times, but ultimately it ended up resolving in a base that resolved to the upside, and things were fine, right? And I do want to point out that while I think that there's a lot more potential for negative price action here, there is still the potential that we just base out and we continue to hold this level around 250 to 260 and make our way upwards, right? It's not necessarily the end game yet, but there's enough warning signals here that I think we need to be defensive, much more so than we've been in the past. And something that we need to really continue to focus on is making sure that we are preserving capital right now. That is the number one game when the market is in these states, is to make sure that you don't blow out your account trying to guess and trying to hold on to names that you really shouldn't be holding on to. So that's the big thing that I really want to stress is make sure that we're playing defense, make sure that we're waiting for a better market, and then you got to take advantage when the market improves. But right now, like I said, I'm not saying you shouldn't swing trade at all. After all, some of us swing trade for a living, or just swing trade to make sure that we can add to our monthly income. And if you're okay at swing trading, if you have a positive expectancy, if you can make money, then this is a time to at least, you can still swing trade a little bit, but you should be more careful. Now, for those of you that didn't make any money in the last couple of years, right? If you were making money throughout 2016 and 2017, you probably shouldn't be trading at all, because this is a much different environment. This is a much more difficult environment, and the type of environment that makes it much easier to lose your money. So if you were struggling throughout 2016 and 2017, then this is going to be even harder, right? So I would suggest that you sit on your hands and you wait for those critical moments where it's a lot easier to find trades. There are even during a tough market like this, even in bear markets, there are certain times where trades are crystal clear and it becomes easy to go ahead and get in with and time a good trade. But right now it's not one of them. Right now there's potential with an FOMC day, with the market below critical levels. There's just so much going on here that could really affect the trade from day to day. With everything that's going on with the Fed, with everything that's going on with Trump, there's so much that could affect the markets, where one day everything looks positive and the next day it looks terrible. And that's really what we've gone through over the last 2 or 3 months. You can see the wild swings in price action, where we come straight down, then we go straight up, then we go straight down, then we go straight up, and then we go straight down, right? It could be, again, that we go straight up, and it's hard to really gauge when that's going to happen. And it seems like the narrative changes immediately just based off of a couple of news events, which I think more than anything, again, shows that we're in a market that's in a really sensitive state right now, in a really emotional state, and one that's very difficult to predict, because it seems like it's trading at the whims of sentiment, which is shifting very, very quickly. So that being said, again, we're trying to figure out what we can do for those of us that do trade regularly, and where we can go from here. Now, if the FOMC has a good statement, or we have a good reaction to that FOMC statement, then I do think we kind of make our way back up to 263. And then from there, like I said, I think it becomes a critical evaluation of the stock market and of the price action as to whether we top out at 263 and come back and head down, or whether we continue upwards. Now, if we have a poor reaction to FOMC and we break the lows, then things could get ugly really, really fast, because the lows right now are very close to the year's lows. And a matter of fact, we've lost them on IWM completely anyway. And if we lose these, then we could really have a pretty big swoop down in the next couple of days. So we need to be very, very careful. Now, again, I anticipate that we go up from here. I anticipate that this support holds, but I'm not that confident in saying that we're holding for sure. Not like before. Back here, I said for sure we're holding. And even in October, I was pretty confident that we would correct a certain amount. At this point, I'm not confident at all that we're going to bounce. I think that we do, but I wouldn't say with any kind of certainty. I think at this point, I'm going to be very careful and make sure that I'm really 100% certain of the move before I go ahead and get involved, if I get involved at all. Those of you that maybe follow me on Patreon know that we haven't taken a lot of trades the last couple of weeks. We've been putting some stuff on our watch list. Really, the gold trade is one of the only ones that's been that we've kind of been on for sure, and that's because the market's not giving us much. And so I give updates and I give charts to put on watch lists, but I've been pretty like inactive as far as trading stocks, because this isn't really the place to go ahead and try to trade a lot. And I think that might continue for the next couple of weeks. But again, we'll see what happens with FOMC and how we react to that. So if we take a look at the NASDAQ, you can see again, the critical level we need to watch is 162. Not quite that far away on the Qs. And also, relatively speaking, we haven't actually approached the year's lows on the NASDAQ, right? So despite the fact that the NASDAQ has been weak, a lot of the FANG stocks, Facebook, Apple, Netflix, Google, Amazon, they've been struggling. But despite that, when you compare this to what we're seeing on the S&P 500, it's not pretty, but it's not necessarily as bad as far as when we look at our levels of support, right? We still have a way to go. So even if we drop down, maybe the NASDAQ can hold around 154 and stabilize there. But again, what I'm anticipating right now is that we make our way back up and start challenging this price area around 162, 164, 166. Now, of course, it's imperative that we have a good reaction to FOMC for us to do that. If we don't, then we're probably just going to stall out here at 159 and then maybe even print new lows. So it's critical that we watch that. But I think the key levels that we want to watch as far as today's reaction to FOMC is what happens as we approach this level around 163, or what happens as we approach the lows from the last couple of days, right? You can see that we're actually in a bit of a descending channel on the Qs, right? It's pretty clear. And so for now, we have to assume that we're still stuck in this channel. That being said, we did hit the bottom and started to bounce up. So ideally, we will get some good reaction today, and we'll continue to make our way back up towards the top of that channel, right? And I think that's the good scenario. The bad scenario, again, is that we accelerate to the downside and continue to either ride the channel down or break below it and challenge this level around 154 to 152. And if that happens again, I think that all bets are off as far as what we can do, and you really should be even more conservative than what I've already said. If anything, even moving to a good position of cash. All right. There really isn't that much more to say. It makes no sense to discuss anything about 180, 178. Those levels are very, very far away and not something that we really should be concerned with. I think even if we have a massive run up here, chances are that we would only get to 169. And then from there, we would probably really struggle to get outside of that channel. So that would be, if we have a really strong run from here to the end of the year, let's say we finally get just a last-minute Christmas rally, then I think maybe 168, 169 would be in the cards, which would be the top of the channel. And that would probably be about the end of what I would expect out of that. And that would be really positive at the very least, because, again, we would end the year on a positive note. We would end the year still trading sideways, which was ultimately what the expectation was to begin with. And some of this negativity that we're seeing right now would maybe be forgotten, because we'd be back up towards some more substantial price areas, and maybe we digest a lot more supply and are able to kind of hold off and continue to build sideways. And again, I think ultimately, for those, I know this Wednesday so far has sounded very sort of doom and gloomy, but ultimately, my anticipation, what I anticipated this year, has sort of played out, and I don't think anything has changed really, which is that we trade sideways. And if we go back and take a look at what happened before, and on the NASDAQ it's a little bit different, but we traded sideways for a good 2 years, right? Particularly when you look at the S&P 500 and you look at the Dow Jones. So there is a very real possibility that this continues into at least the middle of next year, if not all the way through next year, right? And if that's the case, then ultimately it's important that we hold at this level now, so that we can approach the new year somewhere in the middle of the base and then have room to kind of come back and backtrack, or to come up and test the top and continue to trade sideways. I don't think that it's necessarily a bad thing if we trade sideways, because again, that's ultimately what you need when you have these strong price moves up or down. Eventually you need these bases to digest the price action, to have enough shares exchanged between buyers and sellers to get new buyers and sellers in that are willing to accept the levels that are in here, right? So just on a quick explanation of what happens here, when you have price that goes up from say 110 to 170, you have a lot of traders that you would think they're comfortable because they're in from so much, but they obviously want to take profits, which adds selling pressure to the name, right? And then you have other traders that have seen it move up so much they want to short it, which adds even more selling pressure. And you have less buyers that want to buy because they don't have confidence in levels these high, because their confidence is in the levels down here that they feel like they missed, right? So what you need is enough buyers and sellers to exchange here so that you get rid of the traders that wanted to take profits, you get rid of the traders that wanted to short at the top, and you give confidence to the traders that couldn't buy because they didn't want to buy anything above, say, 120, 130. Once they see that price moves back and forth through here, they start to gain more confidence in this level, and they start to start buying at this level. And then you have new buyers that are in here waiting for a much higher price to take profits, right? And so as you get that sort of exchange happening more and more often, you start to build out a base and you start to build up momentum to be able to eventually move past it. Now, if This doesn't always resolve in the prior direction, of course. If for whatever reason you continue to find too many sellers that just don't have confidence in that level, ultimately the equity rolls over and falls below that base, right? But more often than not, what happens is it resolves in the prior direction, and you continue to make your way higher. But you need these bases in order to digest that price action and to get that exchange between buyers and sellers, right? And so that's where we are right now, and that could play out for a while. It's not always that you see this and it turns into a top and you ultimately roll over and come back down. That's definitely a very potential scenario right now, but that's not always the case, right? Sometimes you just trade sideways. And so if we can close out the year above 162 to 166, somewhere in this 167, 168 area, then I think at the very least it gives us the positive expectation that we could start next year anticipating sideways action as well, not necessarily a crash, right? So that's kind of important. So we are actually at a pretty critical point here, depending on how we react to FOMC. Because again, if we lose these lows and we start challenging the year's lows, then that's a really bad sign, because that means that chances are that we even start next year at new lows, and have our eyes looking down instead of up or even sideways. So again, more than anything, we really want to see how we react to the FOMC. And one of the things I always stress during FOMC days is you don't want to just react to what happens at 2 o'clock, even what happens at 3 o'clock. You want to wait to see how we close today, and then you want to see how we really move tomorrow, and ultimately even how we close Friday. But I think by tomorrow we should have a good expectation of what the total reaction was to FOMC, and then from there we can really start to decide whether we can expect price action to stay in this channel, or whether we're looking at really testing ultimately all our support levels on all of our indices. And so those are the levels on the Qs. You'll find that the Dow Jones is actually very similar to the S&P 500. We've already begun to test the year's lows. You can see this level around 235 is very critical. A couple of wicks, maybe a couple of points below that, but this is kind of a key area here. I'll go ahead and put a trend line for now. And like the S&P 500, we lost a level, we broke down below it, and so at this point, even if we rally up to 243, I think the price action is still suspect until we can get past that and start to really get back towards the 250 area. And the Dow Jones, honestly, even at 250, this looks like a lot of selling pressure that's going to really roll over. So ultimately, this is not a good look for the stock market right now. This to me looks like a stock that's, if I was looking at this as a stock instead of the market, this is something that I'd be looking at shorting at either 243 or at 250. Or even, ultimately, even if we had a ridiculous run-up, I'd still be looking to short it even up here at 256. I think there's been enough erosion in price action where this is not something that's positive. Now, that being said, a lot of times stocks like this look bad, and ultimately you get up here and you do get a short, but it doesn't come all the way back to lows, and eventually you just chop around and you get that price digestion that I discussed earlier, which of course is a hallmark of big consolidation ranges. And then ultimately it stabilizes, you test this level again, and then you build out a base and you eventually are able to test the top of that. And hopefully that could still play out with the Dow Jones. But for now, this doesn't look good. Right, and again, it's very reminiscent of what we're seeing on the S&P 500, which is we've got a couple of wicks here. The 3-day price action looks like maybe we're stabilizing and ready to bounce. But when you look at where we were last week to this week, there's a lot of overhead resistance. When you look at where we are this week to the last couple of weeks, there's even more overhead resistance. And overall, all the moving averages are turning down sharply and curling down to meet price action. And it's just, there's so much more potential for negative price action than positive that I don't think it's a great time to trade very actively. Even if you're short, like I've been saying all this with respect to trading long, but even if you're someone that trade that right now, you're nimble enough that you've traded and you're quick enough that you've changed your attitude towards the market and you've been shorting, even if you're a short trader, this is not that great of an environment because we're oversold. We're extended at support levels, and at this point, you probably want to wait for a retracement before you short again. So even with respect to short trading, right now I'm kind of sitting on my hands because most of the trades that should be good shorts have already moved down considerably, and at this point are so extended that the risk reward is just terrible. The timing of the trade is not great, and you'd have to really ride the momentum in order to get a short trade to work right now. So overall, I just don't think it's a point in the market where there's much. There's not a lot of promise to the long side. And there's not a lot of promise to the short side. If I were trading right now, the names that I've added are all names looking for long plays, only because I think that we're due for a reactionary bounce. If we do get that bounce, I think a lot of short plays will materialize, and I think that might be something we need to look at as we start to approach some of these levels of critical resistance. But at the moment, there's not a lot going on other than to see what happens with the market and see if it could provide us a much easier opportunity to either short or go long. Now, that being said, again, there are a couple trades that maybe are setting up as long plays here, and that might be worth taking. And hopefully, you guys have some. Scott, you said shorter, but you're out today. I know you've been shorting, Scott. You a couple times you've asked the last few weeks, and you've been pretty good about reacting to these. So it's good to see. But you're out today, and for a good reason, right? And I think that we need to probably wait for more short plays to set up. That being said, I think there are a couple long. Hopefully, maybe you guys, some of your chart requests have some long plays that maybe are worth taking here, because I do think that we could probably bounce over the next couple of days. But once we get that bounce, I think some new short trades will probably materialize. Now, let's take a look at IWM. And this is just this is the ugliest of the ugly, right? You'll notice even today's bounce is pretty lukewarm. Not a lot going on. We did get the two tweezers yesterday. We've got this nice little bottoming attempt. But that's it. That's all we can say. We're below the year's lows. This is a chart that's already breaking down. You can see where we were this year, what we've done, right? Even if we include the lowest wick of all the wicks, we are well below this year's base. So traders clearly have no faith in the riskier assets of the small caps and have abandoned ship for the most part. Now that being said, because IWM has been for the most part weaker over the last few years, relatively speaking, other than its one shiny moment in the middle of the year where it broke out to new highs. For the most part, the small caps have been very weak for several years now. You notice their base from 2014 to 2017 lasted longer, had new lows printed compared to what we see. Again, I'm going to real quick shoot over to the S&P 500. Take a look at what the S&P 500 did. Take a look at what IWM did, right? You notice IWM broke to new lows around the end of or the beginning of 2016. You'll notice that we had this long base here where the other markets were all zooming straight up. IWM actually struggled through a good portion of 2017. And then 2018, they've ended up kind of coming back to that level, right? So because of its weaker nature, you don't have that price vacuum like you do in the other indices. So there's a chance that we stabilize either here or a few points lower. And that could maybe be ultimately the low that we see for now. But it's not pretty. This is the chart that I told you guys to watch last week and said if we break new lows, be very careful. And we broke them to start the week, and we have not come anywhere near recapturing that level, right? So when you see something like this, this tells you that there's just not a lot of buying right now. There's not a lot of demand. There's a lot of selling pressure. And the selling pressure has not really abated. We're still seeing a lot of the same selling pressure that started in October, and it's not done yet. And until it's done, you really should be a lot more careful and just making sure that you don't get caught up in this and try to guess the bottom. This is almost the exact opposite of what happens when a market's rallying strongly, where everyone tries to catch the top and try to guess what the top is. At this point, everyone's trying to guess what the bottom is, and that's a good way to really do a lot of damage to your trading account by thinking, well, it's moved down so much, we're due for a bounce. And it's okay to guess that. It's okay to think, oh, we're due for a bounce. But it's not a good thing, and it's not okay to buy blindly expecting that bounce. You want to guess that there's a bounce, but you still want to wait for the candles to at least give you an entry signal that's worth taking. You don't want to just buy because we're at a new low. And that's kind of where we are right now. And I think the big thing to point out here as well, which again leads towards the idea of maybe waiting for more short plays to set up, is that even if we bounce here, we're running up into some really stiff resistance because we've lost we've lost the base for the year, right? So if we come back to that level, that's going to be even more selling pressure. And if we get back above it, then we've got even more selling pressure up here at 145, and ultimately all the way back up at 152, which is the break even for the year on IWM, which at this point looks like it might even be a pipe dream. Unless we get a tremendous rally over the next few days, which is pretty unlikely considering how bad the selling pressure has been, we will most likely close the year negative on IWM. I'm not that concerned about closing negative on IWM as long as the other indices are positive. If it just kind of came up and held up around 145, 146, that'd be fine. IWM concerns me if it keeps going down. If it goes up, as long as I don't care how far it goes up, as long as it doesn't keep going down. I think that's still the same analysis from last week and even the last couple of weeks, which is if you're looking, you want to watch IWM for new lows. If we're getting new lows on IWM, that's probably trouble across the board. If it rallies, then you're not really concerned with how far IWM goes. In that case, you should be more concerned with where the other indices go because they have the stronger price action and have the more critical levels they need to get past. I think IWM is going to really struggle with its overhead resistance levels, and it's not something we need to concern ourselves with too much. That being said, those levels, as I pointed out before, are pretty clear. We've got 145 or so, and we've got about 153 to 154. Now, we do have the wicks from earlier in the year, right? We've got this level around 142, and that could be a point of contention. As you can see, that was where we stalled out last week, and that could be an area that provides some temporary resistance, but I think ultimately the key level here to really watch is right around 145, and I think that's the area that we really need to try to get back to and try to reclaim, and we'll see whether that can happen or not. Like I said, it's not a pretty picture on IWM, and as long as this picture stays ugly, we really shouldn't be too excited about trading right now. And I think when we get to that, there probably will be some good short names that we could look at as far as some high probability setups. All right, so not pretty. That's the stock market, and like I said, I think more than anything, it warrants caution, right? I think that we bounce here. I think ultimately we probably get a good reaction off FOMC, but I don't have enough conviction to really trade to the long side right now. There are a couple names on my watch list that I will maybe take a long trade on, but for the most part, I'm sitting on my hands and waiting for better plays in other areas. Let's take a look at the U.S. dollar real quick. You can see that the U.S. dollar still kind of holding at highs. It did pull back over the last 2 or 3 days, but it's done that 3 or 4 times now. And until we see a slowdown of this trend, we have to assume the U.S. dollar is still really strong. But when we look at the different crosses, there may be some weakness creeping in. The euro is starting to really try to break out here. We had last week we were watching. I'm going to do this real quick, actually. I like that, like this. So last week, this is what we saw, right? And we were saying it has this triangle. We need to watch how it resolves. Now, we had a false breakdown, right? You can see it tried to break down below that channel or below that trend line, and then it rallied right back up. That's usually indicative of a further move to the upside, right? So here was the breakdown, and then we've kind of come right back up, right? A lot of times when you get this false breakdown in one direction, you get a real strong move to the other side. So I would say right now, it's probably a good idea to anticipate a breakout of the euro for around 115. It hasn't done it yet, but there's a good chance that it does. And if it does so, the U.S. dollar might pull back even further. And if that's the case, then that might work out even better for the gold trade, which we've been in, which has been doing pretty well for us. Now, interestingly enough, if you look at the U.S. dollar versus the Canadian, it's been incredibly strong. And a big function of that is how bad oil has done. But you can see, Frank and I, again, we're discussing this today as well because he's Canadian and this affects him. The Canadian dollar has really struggled versus the U.S. And at this point, you can see the U.S. dollar just continues to really run up, and it's at the top of the channel again. And even if we do get some selling pressure here, it's still within the midst of a really strong ascending channel. So overall, this chart shows strength for the U.S. dollar, but I think this is really more indicative of weakness in the Canadian dollar than anything because the U.S. dollar has also started to lose some strength versus the yen. So we're seeing it slow down versus the yen and versus the euro. which ultimately means maybe the US dollar could slow down a bit more, which will give a little bit more relief to some commodities. And that leads us to gold. For those of you that have been here for the last couple of weeks, gold has been in a trade that has been worth taking, right? I mentioned this way back here when we first started to peak out around the 115 level. It was on my Patreon page. I put up a trade. I also put up a video exploring more opportunities with the gold trade, and a lot of them have been working out pretty well. A lot of the gold miners have done well. Sadly enough, one of the names that we looked at last week as a chart request, Bear Gold, has not done well, which is kind of odd. I can't remember if I think someone here had asked about it, and it's actually not doing well. But for the most part, most of the gold names that we've been watching have actually been doing pretty well, and GLD has been doing well, and GDX has been doing okay. Now, part of the problem with trading gold miners is that you get some of the gold move, but you also get some of the equities move, right? Because they're still equities, they're still companies, right? So that has been one of the issues with this GDX trade really taking off, or with some of these gold miners really taking off, is the fact that the market has really struggled. So if we can get a bounce, FOMC induced, if we can get the US dollar to drop a bit, hopefully FOMC induced, then we might get even more lift off of gold, and in particular some of those gold miner names. So I think that this is still an area that we can look at. I think it's an area that is to a certain extent insulated from what we're seeing in the markets, and is an area where you can look at trading without exposing yourself to a lot of the ugliness that we're seeing in the markets. And I think that's kind of the key when we're trying to be defensive, is to look for areas that are insulated from the market, whether it be trading currencies, whether it be trading cryptocurrencies, which again have also had their own ugly year but have started to gain some life, or whether it be trading commodities like gold and silver, or as I mentioned, even trading like utilities and stuff, although those guys have really struggled as well with the really ugliness that we've seen in the markets recently. But I think the gold area is one of the sectors that we could look at that could maybe give us some trading action where we're not necessarily impacted as badly by what we're seeing in the overall markets. You'll notice SLV has gained some traction, but still nothing at all like gold. We're still at very strong levels of resistance. I still think if you want to trade precious metals, you should just be trading gold or gold names, not silver names. There's just not as much demand right now for silver, for whatever the reason is. And it could break out of this base and start to rally, and if so, that can be a nice trade. But I suspect that if it does break out, that gold will break out just as strongly from its levels. So overall, I think gold is still a better area to look at. And then finally, we have oil. And oil has been just really ugly. You can see new lows, and we're stabilizing today, but overall it has not been able to base out, has not been able to bottom out. And at this point we're starting to approach some lower levels. We're at the middle of this major base, and I think even if it rallies now, it becomes a shortened opportunity at 55. And at this point, it looks like it may even head all the way down to 42 before it's all said and done. So I'm not really looking at trading oil names right now. I think a lot like the markets, it probably bounces, but there's enough potential downside here that I'm not really into it right now. So I would say out of the commodities that we like to follow, gold is really the area to focus on, and should be really what you're looking at as far as any kind of long plays in the market right now.
Hey Rob,
Yeah.
just a little mention on those oil. I feel a little bit different on the oil. I was considering adding back to some of the larger oil names. They got nice steady dividends. If you remember, the last time I picked them up was on that major drop,
Right.
like Exxon and ConocoPhillips and the Canadian one, Suncor, and they actually have steady dividends. So the last time I bought them was as we came up off those lows. I ended up selling a bunch when it ramped up, and I was waiting for another major drop. I still kept them anyway, just because the dividends are so nice. But this area here, and even if it gets a little bit lower, I think might not be too bad. You can see the drops on some of these, like Suncor and with XOM and that ConocoPhillips
Right.
CPO. They're actually not bad, like how far down they've come. So unless they cut the dividends, I don't think they've announced any dividend cuts. Maybe we'll know in the new year. Uh, and if you remember that last time, which one cut the dividend? There was one that cut the dividend, but then it came up after it cut the dividend. We actually bought into the dividend cut and it actually bounced back up. So uh, I think they've come down quite a bit. This one being hit because of the U.S. Canadian exchange as well. So that's probably why we're getting it a bit
Right.
weaker than it was even last year. So I was actually looking at these. So I've got smaller positions on these, but if you remember, I sold some into the ramp ups right away just to protect some profit. But I kept the rest just because the dividends are okay. So if you're going to trade into these, the smaller oil companies do come back stronger when oil bounces. But they're actually also quite weaker too because you don't have that support of a dividend. So I think the opposite, that maybe building positions on these bases are good, especially the fact that OPEC said they're going to be cutting that production. That takes a while to kick in between all the different countries, but I think we'll start seeing a base again, unless, like they said, that there's a slowdown in the world economy, like we were talking about earlier. So I'm on the opposite end. I think buying these on the dips of oil and then basing it on the chart itself, looking at each one individually, and then look at the individual dividends to see if you're happy with them. Um, and I was actually giving some advice to someone I know that has some money that they were trying to decide where they want to put it, maybe into something that's a little bit weaker in this market. And we actually discussed the oil names as one sector to maybe put some money in, just because of the dividends are healthy. So if you look at some of these and your dividends haven't been cut and you're happy with them, you got the potential of making money on a bounce back up. If it goes lower, you can actually add more, sort of like what we did the last time when we did it. It was into the spring of the year before when we started to buy them on the dip. They went a little bit lower, and then we bought again as it was coming back up. So we didn't even catch right at the lows. We caught as it was starting to come back up into those hammer candles. Okay, but you'll see very similar charts. This one actually holding up pretty good on ConocoPhillips, as you can see. It's not as bad as the other drop, but like they said, the other one with Suncor, it's because of the U.S. exchange that we talked about. And XOM, you can see right into the lows again. And this one's had a tougher time bouncing back compared to the others. But right now, I thought it was at a decent level. I was looking at it the other day with the guy, and we were saying if it goes a little bit lower into the low 70s, might be pretty decent. But anything under 70, I would actually add to this one as well. So I just wanted to point that out, just because you got that supported of the dividends as well, which I think is a good thing. So you can see they've been pretty steady. Each earnings, you get a nice little dividend every quarter. So and it's sort of like offsets that. The chart isn't great looking right now because it's trying to base out, especially on this one. But I think anything lower, you got to pick it up if you want to just park some money and get the dividend and wait for an oil recovery. Okay, any lower on oil, the smaller companies, if you remember, I did a really big analysis on the oil companies when oil had really drifted back. And we looked at it in depth at the time. And there was a lot of smaller companies that went bankrupt during that time because they can't afford to produce and stay afloat. And it's harder for them to get financing to stay around. What happened to the bigger oil companies? They all survived. And that was our strategy, to buy these when oil drops back, because they have an easier time surviving. Also, anytime oil drops, the smaller companies can't survive, so they go bankrupt. We had the most bankruptcies in oil companies during that last big drop. That's a good thing for these guys, because anytime oil bounces up again, these guys become more powerful and stronger, and they get a bigger chunk of that market again. Okay, so that's why you see that happening, and if it happens again, you can bet that I'll be benefiting from it again. Okay, but I was actually considering it either into the end of this year or into the start of the year. I'm going to be adding to these positions again. So I'm actually happy I did it. I wish I sold more at the higher levels, but onto these dips, I'm definitely going to be adding. I'm just deciding when. Okay. So I wanted to point that out, Rob, because I felt a little bit different on this in terms of with that big oil drop that we've seen. That's the time to get excited when people don't like those type of drops. These companies will survive again, the bigger ones anyway. And having that dividend just gives that little bit of extra thing. Now, like I said, they might cut the dividends, but even the one that cut it before still ended up doing pretty decent. It still survived, and it actually bounced right after they cut the dividend, which was surprising. So, okay, and then I mentioned that.
Thank you, Frank. That's a good point. One one thing I do. So we saw these charts, and Frank did point out charts that all actually have pretty good support levels on the weekly charts, right? Pretty long term looks here at XOM, at ConocoPhillips, and at Suncor. All of them are actually you saw when I was looking at them. They all had nice support levels. And Frank brings up a really good point on those that actually that have a dividend. When you're defensive like this, I think dividends are a pretty critical thing. That was one of the things we discussed last week on my Patreon page, was looking at utilities and looking at REITs, because they pay dividends, right? And that's a way of manufacturing a return on your holdings. Is you buy something that pays a dividend, and hopefully it's something that's pretty stable, and you can even sell calls, and that way you can actually manufacture a return on a stock that, as long as it doesn't just go straight down. If it goes sideways, you actually still get a positive return, because you're still collecting dividends, and if you have good timing, you can collect premium from selling calls against that name as well, right? And that's one way to navigate more a sideways market than a crashing market. That was one of the strategies that I really was focused on at the beginning of the year, when we were looking at a market that I anticipated to trade mostly sideways. And if we end up holding up at key levels across the board on the indices and trading sideways, that's something that you probably need to focus on if you want to continue to be defensive, is look for names. Now, that being said, I think that Frank's probably a little early, but he tends to be more aggressive than me when it comes to buying these names at support levels. And I think the idea is valid. They're all at pretty good support levels, but I haven't seen any kind of candles proving support. And I think when we see it on CL, we'll see it across the board with these names. And he'll be waiting for those support candles as well. He's not going to just buy today based off of where it's at. But yeah, so that's actually an interesting idea. Some of these oil names, there are a lot of them, and we just touched on a couple of these big ones, and all of them are at support. I will say this: they all are certainly oversold, and all of them have really moved down. That being said, I like the strength of gold a little bit more, but it's good for you guys to get sort of more opinions when Frank and I are in here. A lot of times we see eye to eye, but every now and then we have different ideas, and it's not necessarily that I disagree with his play. It suits my style to play something with gold that's already moving, rather than something like this that might still take a little bit of time to gain traction. But there certainly is a lot of upside in these oil names if we can stabilize. And I think the key, again, is we need to see a bottom on oil, whether it be here at 47, whether it be at 42. We need to see it stabilize and start moving up. And for that to happen, I think there's still a lot to be done. But once that happens, a lot of those names could get some good price action, and there are quite a few that we've looked at in the past, right? Because you can see on my watch list here, we've got Exxon and ConocoPhillips, but then we've got something like ESV, we've got Patterson, which is a driller. And we're on the weekly charts here, so you can see some of these. This is starting to struggle and lose a key level. Here's Kinder Morgan, we've got Noble Energy. A lot of names, right? And you can see some of them, some of the smaller ones are losing support, right? So kind of reflecting what Frank was just saying. But there's a lot of upside if they can ever stabilize and bounce, right? So maybe it's time to put a watch list and to look at the levels. And if they hold the levels that you like, you can start to maybe go ahead and follow them, right? And maybe go ahead and take a play or two on some of these. But as I mentioned, here are some of the names. And you can see, again, these are all weekly charts. You can see again, how many weeks down in a row is this? 1, 2, 3, 4, 5, 6, 7, 8, 9. So pretty extended to the downside. It might be ready for a relief bounce soon, but I'd like to see some candle patterns showing that it's going to bounce before I go ahead and take advantage or try to take some of these trades. But there are a lot of oil names, and you can go through them and see if you find some that makes sense to you, or maybe there's a certain sector that's doing better than the other, and maybe that's an idea for the future. All right, James, you have a question regarding Canopy and PGC. If it's not too late, it's not too late. We got plenty of time. All right. So seems like we go over CGC every week now, and I thought it was looking like a potential play to the long side, but that has not developed yet. And this is why I wait for the breaks of these trend lines, as I mentioned earlier, is because I want to see a positive resolution to this price action before I get involved. And we instead have had a negative resolution, right? We broke this trend line. So at this point, unless this turns out to be a false breakdown and we can get back above, say, 32, this is actually bad for Canopy Growth right now, because we lost a very critical level at 32 and are trading below it. So at the moment, I don't like this as a long play. Now, that being said, I would change my mind very quickly if we got back above 32 and got on the right side of these three trend lines, right? I think that for this to be a good long play, it needs to be here. Now, this is a name that, to a certain extent, sometimes it maybe is better to ignore the price action. If you're wanting to play something like this for the long term, because you think there's potential in the long term, for marijuana stocks in general, then you always want to buy regardless of where it's at. But I think even if you wanted to buy it as a long-term holding, this is not the place to buy it. You would probably want to wait for a more substantial price breakdown to about 25, 26. And then from there, even if it's down and below all this price action, you can go ahead and maybe say, well, but I'm getting a good value on a name that I believe long-term. But for the price action right now, as far as swing trading is concerned, as far as trying to just get a bounce, this is on the wrong side of all the trend lines, all the moving averages, which only means that there's more chance it goes down than up, right? So at the moment, I'm not too excited about this. And I do want to point out the other one that I had pointed out before, and what happens when you try to anticipate these breakdowns and they don't happen. You look at TLRY, and it had a pretty swift move from 96 all the way down to 68. Now, this is a very volatile name, but again, it's showing you that right now the selling pressure is even affecting these marijuana stocks, and even they are dropping. And at the moment, again, just like what we were saying in the markets, even a bounce here is more likely than not going to come right back up to this support level that has now turned into resistance, and could end up being a play that continues to break down and trade down even further, right? So let's see what PCG looks like. Pacific. So we're back to Pacific is PCG. Okay, I know, this is the California stock. Frank, did you want to mention something on the marijuana stocks before I switch to this?
No, I said so much about them already in the previous webinars that you have up there. But yeah, I still think there's going to be consolidation in the sector, and I think they've all been hit pretty hard in terms of like the dips that they've had. But I think it's buying opportunities on those as the sector improves. And I think some of it was to do with the market that dropped back so hard. So those are higher risk plays. When they move up strong. When they drop back even further than you expect. So it's a tricky sector. But see, with what's her name there, with Freya there getting into, like Marlboro getting into the sector, they bought into a Canadian one, sort of like what Constellation Brands did with Canopy Growth. So they're getting their feet wet. They're going to see how they're going to expand into the sectors and how they're going to utilize all their leverage that they already have in terms of like the farmers that they deal with and everything else. So I think it was a natural move for the cigarette company to get into it. So I think we're going to see more of that, the bigger companies. So whether it's another liquor company that gets in, or another or another cigarette companies as they get out of that e-cigarettes and move into a different revenue stream. I think it was just a natural for them because they can leverage, number one, their cash, they can leverage their connections, their distribution power. They just have so many things going that can help them in this sector. And I think the problem has been, and if Coke and Pepsi get into it as well, right? With the drinks that they said they're not going to get in, they are going to get in, then they're not going to get in again. I think eventually they get in because it's just too big of a potential market across the world as it gets more acceptance. It's going to be like $200 billion market around the world, this whole sector. So it's going to continue.
Right.
One thing I wanted to add on that those oil stocks, Rob. Was the other one that used to look at a lot all the time was Schlumberger, Schlumberger. So remember, that's about 5% dividend.
Oh, what's their ticker again? I forgot.
SLB. And I know you looked at that all the time, if you remember. And look how much that's dropped back. But it still pays a 5% dividend. So it's not like it's a change. So look at this drop on this one. So this is a little bit more risky than the other ones. I never traded this one, but I know you used to like to look at it. But look how much this has dropped. So I have a list of ones that I kept, the ones that I own, but also other ones that I like to see. Like I added them in the chat there on in the webinar here. So the other ones were PCX, VLO, that pays a nice 4.3% dividend. PCX pays 3.69. So they're all around 4%, like I said. And as that dividend goes up, you have that steady money coming in, whether you're waiting for the thing to drop. Now, yeah, we could drop 5% in a day and there goes your dividend. But I'm telling you, this has worked for me in the past where you're getting that little bit of a safety net that they pay you while you're holding. Now, what helps is waiting for like a hammer candle or tweezers on the oil chart itself, and then that gives us that base. And sometimes these lag, and sometimes they lead the oil market. So just know that OPEC's cutting down production. So by the time we see the numbers again, maybe that was enough for them to do that 1 million barrels a day or whatever they're cutting back. So you remember at that last meeting, that's what they decided on. Now, sometimes these guys cheat on the numbers. That's why sometimes they don't go on it at face value. But if we start to see a base happening on oil, then you're going to see some of these coming back up again. And I think these are the times to take advantage. The last time that I bought, the dividend was like this. It wasn't huge, but it was steady. And then by the time it came back up, the dividend sort of like goes down as the price goes up in relative terms. But then you're making it up on the gain on the stock itself. So taking some off works, but you're getting that little bit extra comes into your account each quarter. So to me, that's what I liked. This one I'm surprised dropped so much. So Rob, the one that you just put up, Pacific Gas.
This is so the problem with Pacific Gas is they're the utility, they're the gas, the electric company.
Yeah.
They got in trouble in California. They had
Oh right, the one with the fire. Right. That's the one. There was this one and another one, right? Yeah. Now I understand why it's dropped so much. Because they could be on the hook for a lot of lawsuits, right?
So that's why they got.
So there was another one, right? There was two of them.
Yeah, it was the IX, I believe.
Yeah, I remember when we were discussing that in the chat, and they had dropped so much because it looked like they weren't sure, but it was one of those. Yeah, I remember looking at both of these.
And
so they've actually come back. That covered the gap, eh?
Well,
beautiful.
You know what happened was that for the most part, I think the blame was laid on Pacific Gas instead of Edison. So Edison kind of covered. Well, he continues to deal with some issues, right? So that's why they've had more trouble.
Well, I wish I had looked at that other one closer. That was actually a nice gap cover, exactly what it should have been doing. Right off that. This one's a little bit harder because, you're going to have to see going forward. But just know that in the scheme of all these things, whenever you see the worst happening, like look at after the first 3-day drop, 3-4 day drop there, after the gap down, hasn't really gotten down to that level again. So it might have to retest that level. But if these guys survive, it's almost like, remember that flooring company? That it was the worst when they were in front of 60 Minutes there, and then the CEO lied and he said, yeah, I didn't know about it, but then it turned out he knew about it. That company's still around. I don't know what it's at right now. Check that out as an example, Robert. I haven't looked at it. Lumber Liquidators, LL, and I think it came back up. Oh, it came back up and then it dropped again. Okay, but look back at the worst time where it was. So this is more market related. Look how much it came up after that big drop. I remember it came up quite a bit. So now it's more market related and it's back towards that support. But just know that these buying them at the worst times tends to be not a bad scenario. You got to do it almost like when the headline is completely bad. If you remember the car companies when they went in front of Congress, that's when Ford was $1. It was $1 at the time, I remember.
Yeah.
And GM was like $23. It was after that they went bankrupt and then they had to reset again. I had bought that one, made good money on it. It took a while for it to come back up. But their worst was when they were in front of Congress, when everybody's talking about how bad everything is.
Right.
So even GM, if you look at GM or a longer term Ford chart, these are things that work longer term. Whenever you have stuff that's really, really bad on a sector or an individual stock, if those companies survive, they come back up. Okay. And you get a nice little bounce, sort of like what you saw with the other one that Rob posted. That was a beautiful gap cover, actually. Okay, that's all I have to say on that stuff. And yeah, the marijuana ones I've gone through at length.
Right. No, I know.
There's some good research on that. But okay.
All right. Thank you, Frank. So, so James, on this one, I don't know if you're asking with regards to a new trade, or maybe you, if for those of you that maybe don't know, I had actually posted a video on this around the gap down. I thought that this made for a really good covered call strategy where you sell puts and really take advantage of the volatility. This volatility was massive, and during this area, the puts were, you were getting $3, $4, $5 depending on what level you chose for the put, which is a massive percentage on a 20-something dollar name, right? And it started in the 30s and it continued to gap down, so I had to add, but myself and a friend are in this as covered call plays, and we've actually collected a lot of premium on it, and it's done okay. But I don't know if you're asking with regards to that, or if you're asking as far as still looking at this as a potential play. I think that there's still trouble, right? Obviously, and this is a risky trade. If you are planning on just taking this as a swing trade, I think there are better plays to go, because there's always the overnight risk of a serious carnage on this name. If you are taking advantage of the elevated options premium, then I think this is still a worthwhile play. So my recommendation to you, James, you have 100 shares. I don't know where you bought them. I think that ultimately this could make its way all the way back up to 40, but that's going to be a long ways down. That needs to be when when the skies are clear as far as litigation is concerned, right? And whether they ever, whatever their liability is for those fires. There's a lot of potential bad news that could happen overnight. So if you are looking at this as a swing trade, there are probably better plays to take. If you're looking at this as a long-term trade, where you wanted to take advantage of this and maybe play something like this and kind of hold it for a while, I think you could take advantage of the volatility by selling calls against it and picking up premium. This probably won't gap up at any time soon, unless it's out of left field. There's no liability, but I don't think that's going to happen anytime soon. So I think that this play makes sense as a covered call play, and that's what I've been doing with it. And just the next pop up to 28, you could take advantage and sell calls at that level or at 30, and see if you could pick up a couple of bucks every 2 or 3 weeks, and you'll lower it pretty quickly. Joseph, you're saying that California legislators will likely limit financial risk as voters will bear costs, and I think that's what ultimately happens. That's why I was okay with taking this play in the first place, was because more often than not, these companies get bailed out. I mean, this is an electric company. They're not going to just let it go bankrupt or let it close. I mean, yes, it doesn't mean that it can't go bankrupt and it gets broken up or absorbed by something else. But usually in these situations, it's the customers that pay the cost, or the government, right, that bails it out. And so I thought that it was a worthwhile risk. Now, it was still a risk, right, because there's a lot of downside risk on a name like this. But when you consider the volatility that we were talking about, and the amount of premium you could get on a name of this price on a utility that typically is not volatile, I thought it was a worthwhile play. At this point, I think it's still a worthwhile play, But if you're not collecting premium, then you're exposing yourself to a lot of risk for the potential upside that's not that great unless you're planning on holding it longer term. If it's a swing trade, there's really only about 4 or 5 points of upside. I don't think that it gets back above, say, 30 anytime soon. I think that would be a massive move. I think more likely than not, it's still going to chop around while they're waiting for all the news to kind of play out. And then from there, maybe it clears up and it could eventually mimic Edison and make its way back up into the 30s and hopefully one day back into the 40s. But I think that that's still at least, at the very least, a couple of earnings reports away. And depending on what the new situation is. So, again, I don't know.
Yeah, and just understand on these, the lawsuits and stuff take years. If you check on their news, these lawyers already jumped on the bandwagon to get like a lead plaintiff in, and that's what they'll usually do. That's all usually scary when you're reading that initially. But I'll tell you, I've had a lot of companies where if they don't have lawsuits pending or lawsuits ongoing, it's usually something wrong. Like most of these companies these days have a lawsuit and these lawyers that try to jump on anything that comes up. So almost every company has these now, and the lawyers are the ones that benefit. I actually used to get excited on one. I remember being one of the plaintiffs on it, and I thought, oh, great, I'm going to get all my money back. And I'm getting like $180, and I lost thousands on it. So you get nothing. The lawyers end up getting the chunk of any resolution anyway. But the one thing that could drop it back is, a lot of these companies, when you have an issue like this, if the government investigates them, so whether it's the federal government or California that looks into them, which they'll probably have to, but they're waiting to get the facts straight first. When that happens, you actually drop back as soon as that happens. Okay, but go with the anticipation that, hey, I'm going to add some down here, and I'm going to be adding more if it goes into those lows again. Okay. Right. Now the risk is that it breaks down lower. That's why Rob's play works out so nice, because you end up picking up some free money even if it goes up. So you miss out on if it pops through that level and it goes into the gap. That's where you miss out. But it's a safer way that while something's not happening or it's going to go lower, Rob will end up picking up that money because he's making the money off the people that are banking that it's going to go higher, right? So that's where he ends up picking up that extra cash if it doesn't do anything. If it just hovers here, it goes lower, he's going to pick up money out of it. So my experience with these type of plays, and like I said, I haven't played this one, and but my thing is buying them when they're like really bad or after the government investigates them is actually the perfect time, because then once it's out of the news and out of the headlines, the stock will go up and nobody talks about it. Like people are making money at that point and nobody's doing anything. And I like what Joseph said, that they'll likely pass the risk on to the customers and the voters, which usually happens. If they're the only game in town, that's got to happen. They can't knock them out of business, and they can't give them fines that are hurtful to the company. You need these. It's like it's a monopoly, or when you got oligopolies or monopolies, there's really not much they can do to them to knock them out, unless they want them completely out. So if you remember when Bell controlled everything, right? Like with AT&T, when they controlled everything for phones, they decentralize the whole business so that other companies can get in. That's probably the only time that you're going to see something to that extreme.
But that's like
they can't do this in this case because the infrastructure cost of getting someone up to speed to do that, you can't do it.
Yeah,
right? So that's why that's why they're going to survive. The chances of them surviving are very, very high. It's just a matter of what can they do to avoid this. And I'm sure the company wants to avoid these. Electric companies, they don't like to be in the headlines. They like to be quiet companies. Does this pay a dividend, by the way? Does anybody know? Does it pay a dividend, Rob?
I'm not sure.
I didn't see anything that it did.
I don't think so.
They don't think so? Because usually they do. It's usually a steady dividend, but I don't see anything. It says November 14th dividend date, but I don't know if it's cut. It just says not available. Maybe on my stuff it's not here. But it's usually steady growth. Like it's not like sometimes even just flattish growth. But
right,
everybody knows that your electric bill goes up, your water bill goes up, your Heating goes up, your air conditioning goes up, everything goes up usually. Let me see what the financials look like. Yeah, pretty steady. 17 billion, 16 billion, 17 billion, 17. So it's very steady on the annual side. Yeah, so about 4 billion a quarter that they're doing, and it's pretty steady. So yeah, even if they take one hit, one quarter, or 1 year, if they settle some of these lawsuits, that's going to be out of the way. Once that's out of the way, what do you think what's going to happen? They're going to have to add some extra costs because of that. And if the taxpayers pay for it, then it helps this company, and they go back up into that gap and higher up. So it's actually not a bad one. It's higher risk, but I would say it's on the lower end of higher risk. The chart is ugly right now, but I would agree with Rob. I love his strategy. If you don't understand his strategy, then just go with the strategy of picking some up now that it's off the recent highs, but with the anticipation that you're going to buy more, and just hold it longer term and close your eyes. Okay, people are not going to shut off all their lights, and they're not going to have any income. Their income most likely is still going to be 17 billion per year, and it's probably going to go up from there. Okay, but they usually don't have huge growth. These companies, just steady, like it's just steady money coming in. I'm surprised if there isn't a dividend.
They might have
there
cut
is.
it. Yeah. James,
there is?
Well, James says it used to. I think they cut it. I think they.
Oh, they might have cut it? Okay. And that makes sense, that if they're not sure, that maybe they had to cut it. So I'm surprised I can't get the info on it. Usually I can get it like right away.
Yeah, James, that happens sometimes with when stocks that are in the news, because the overnight news depresses it, and then in the day people buy it once they realize that there wasn't a bad news day coming, so that's like I said, I think you need to take advantage of premium. So I'm not sure what your overall risk acceptance is on a name like this, but after a down day like yesterday, selling puts is an okay option to maybe get more premium into it. But of course, you're absorbing extra risk in case it does drop and you get assigned. But that's the way I'd play something like this, is to take advantage of the elevated premium, because yes, it can go up, but there are plenty of names that could go up also that don't have the overnight risk that this does. So if you're not taking advantage of the premium, then there might be better place somewhere else. But like Frank and I both agree, I think the chances are ultimately that this thing leaves this in the rearview mirror and eventually makes its way back up into its previous price, which as you saw in the weekly chart, for the most part, this is a $40 stock. It's been that for the last several years. If you go back and take a look how long it's been a $40 stock. So ultimately, that's the price it belongs in. But it just has to leave all that in the rearview mirror before it's ready to go back to that price. And it's a matter of whether you're willing to accept the time it takes to get that. But more than anything, to me right now, the premium is the idea, because it shouldn't move much, but it still has a lot more premium into it.
Yeah, and remember, you're buying it now while the market's down, so that puts added pressure on it. So again, like Rob says, it all depends on what you think is a good risk to reward. You've got a lot of stocks that are great risk to rewards at this point because of the drops we've had. So good discussion on the oil names there. But this one here, I agree with Rob. It should be good. That's what I posted too, that it should go up to 35 to 39 there, to that 40 range. And it should be a $40 stock once this is in behind the rearview mirror and it's not in the headlines anymore. It definitely shouldn't be a $20 stock probably, but it could drop down there. So just know that there's those headline news that move a stock like this while it's still in the uncertain area of what happened. So it depends. How much can you make out of this? Can you make more on a stock like Facebook or the oil names than you can on something like this? So balancing it out on your portfolios, guys, and try to determine, okay, what can I pick up and hold a little bit longer? What's my time frame? Okay, can I handle added pressure to the downside if I wake up one morning and it's down to 17? If you can't, then you can't trade a stock like this. But if you're okay with saying, okay, I can take the risk and I don't mind holding. I understand the industry. I understand the risks involved. I understand that they're going to do a dividend again if they did cut it like what you guys said. And again, I can't.
Well, he just
find it. I've got a site that I
Well,
You
he
can
just put
check
a
all the
link.
past dividends and everything.
He just put a link
So,
saying that the bailout will probably resume once they're bailed out, then the dividends will probably resume. So they probably
okay, then I'll
that's
start
why it's
again.
probably
Okay.
not updated on those sites because
And
it's
if it does, that's usually when the stock will push again, because then it's not the retailers that buy it, the retail investors. It's actually funds that pick it up to say, hey, we're going to need some money into some safe things. At least now we know that the dividend's back. And these guys wait till the last minute. They could care less if it's 28, 29, or 30 at that point. They'll end up picking it up
right.
then. That makes sense. Yeah, good discussion. This is really good stuff, guys. So listen to what Rob says. It's good stuff.
Thank you, Frank, and that pretty much covers it for today. I want to thank you guys for your participation. Frank, thank you as well for adding extra. And yeah, let's watch to see what happens here. It's almost 2 o'clock, so we'll see FOMC shortly and see how the market reacts to that. So, um, make sure that you guys play it safe for now. There's a lot of uncertainty in the markets, and I think we need to be careful. But let's see what happens from here to next Wednesday. Hopefully, by next Wednesday, we're kind of at the break-even spot for all the charts. If you guys need to ask Frank or I any questions, you can always find us on Twitter. You could join us on Discord if for whatever reason the market makes you more nervous after whatever happens today in the afternoon. Other than that, have a good rest of today, and we will see each other again. Well, I don't know if we'll see each other next Wednesday. Next Wednesday, the day after Christmas. We may or may not meet that Wednesday, but I'll put it out on Twitter. Next week is probably gonna be a very light week, depending on how things go. But more than likely, we'll meet again next Wednesday. Okay, guys? Have a good rest of the week. Thank you, Denise. Merry Christmas to you and to everyone here as well.